Welcome back to the Deep Dive. Today, we are strapping in for what has become one of the most painful corporate stories of the last quarter. Cracker Barrel Old Country Store.
That's right. We're tearing apart their fiscal Q1 2026 earnings call, which covers the quarter that ended back on October 31st.
And this was so much more than just a typical earnings report. This felt like a full-scale corporate reset.
Absolutely. I mean, investors knew the news was going to be bad. The brand damage story was already out there. But the sheer magnitude of the guidance cut and the operational collapse, that demands a serious look.
Exactly. Our mission today is to filter out the noise, distill these really shocking financials, and understand the dramatic pivots management is now trying to make. The big question is, how does a brand built on nostalgia recover after actively damaging its own foundation?
Let's just jump right into the headlines that hit the wire on December 9th. The financials were a brutal mixed bag. They really tell a story of a business just running out of operational oxygen.
So give us the raw numbers. What did the bottom line look like?
The GAAP net loss for the quarter was $24.6 million.
A loss. And what was it the year before?
That's the key. The prior year, they actually had a gain of $4.8 million. So that huge swing gave them a GAAP diluted EPS loss of $1.10.
A staggering reversal. But I did see a tiny technical silver lining in the adjusted numbers. Was that real?
It was, but you have to emphasize tiny. Adjusted diluted EPS came in at a loss of 74 cents, which you're right, it narrowly beat the consensus estimate of about a 78-cent loss.
Still like a 5% beat.
A 5.1% beat, yeah. But as we know, the market does not trade on these narrow technical wins when the entire foundation of the house is crumbling.
Right. And the reason that Slim Beat didn't matter at all is because of the top line, the revenue.
That's the core of the problem. Revenue was $797.2 million. They missed the consensus, which was sitting up closer to $800, maybe $808 million. That's a 5.7% decline year over year.
But the truly alarming figure, the one that tells you about the health of the actual business, that was the adjusted EBITDA.
Mm-hmm.
Right?
Yes. And let's slow down on that for a second. When we talk about adjusted EBITDA, you're essentially looking at the company's core operational cash flow.
Before all the financing and accounting stuff.
Exactly. And that number, it collapsed. It plummeted from $45.8 million in the prior year down to just $7.2 million this quarter.
Wow.
It's not just a drop. That shrank their already thin EBITDA margin to roughly 0.9%. That signals severe financial distress.
So with that revenue miss and the profitability just gone, the market rendered its verdict pretty quickly.
It did. The stock fell about 4.9% by the next day's close. You just see total investor caution here because those numbers signal something systemic is wrong.
Okay, let's unpack that, because this isn't just a bad economy. This feels largely self-inflicted. The revenue miss wasn't pricing, it was. People just stopped going. It was a traffic problem.
A massive traffic problem. You have to remember, the restaurant is 81.6% of their entire business. Comparable restaurant sales were down 4.7%.
And that was driven by what exactly?
Almost entirely by a traffic decline of 7.3%. And the retail side, the country store, even weaker, down 8.5%.
And management, to their credit, didn't really hide from this. CEO Julie Masino basically tied it directly to the brand crisis.
She did. She called the results below expectations and pointed to unique and ongoing headwinds, specifically referencing the brand reputation damage from that whole controversial logo and store remodel backlash.
The speed of it is what's so fascinating.
It's incredible. Traffic was only down 1% in the first half of August. Then, for the rest of the quarter, it dropped to negative 9%. It just coincided perfectly with the public backlash. Hit them like a freight train.
And if a 7.3% decline for Q1 wasn't bad enough, they gave a truly shocking number about what's happening right now.
They did. Q2 to date, so November and early December, traffic is running at approximately negative 11%.
Negative 11. That is disastrous territory for a restaurant.
It is. I mean, they tried to put a positive spin on it, saying the weekly pattern has stabilized at that level, but negative 11 is a significant step down from the Q1 average. They are hemorrhaging customers.
And all this is happening while the macro environment is still pretty hostile. What are they saying about costs?
Yeah, their costs are still going up. They expect commodity inflation to be between 2.5 and 3.5% for the year. And crucially, hourly wage inflation is still in that 3 to 4% range.
So even as traffic falls off a cliff, their costs for food and labor are still climbing.
Exactly. Squeezing that collapsed margin even further, they need immediate relief.
Which brings us to the strategy. With profitability basically gone, they had to pivot into deep repair mode. What are the immediate cost actions they announced?
They're focused on aggressive internal housekeeping. First, they're accelerating a restructuring of their corporate support center.
G&A cuts.
Right, general and administrative. They're targeting annualized savings of $20 to $25 million. And they expect most of that to hit by the end of Q2, which tells you they are cutting deep and they are cutting fast.
Is $25 million enough, though? Or is that just window dressing for the activists?
It's both, frankly. It's necessary to offset the margin loss, but it doesn't solve the core traffic problem. They also said they're reducing planned advertising spend by $12 to $16 million for the rest of the year.
Wait a minute. Your traffic is running negative 11% because your brand is in crisis, and you're cutting the ad budget.
I know. It's a massive risk. It just signals desperation to protect the bottom line, even if it hurts their ability to, communicate their turnaround story.
Yes.
They trimmed their CapEx plans pretty significantly, down to a range of $110 to $125 million, and that's mostly just for essential maintenance and replacing their point-of-sale systems.
We also saw some store closures.
Yeah.
Right.
We did. One underperforming Cracker Barrel, and notably, 14 Maple Street biscuit locations. They are clearly signaling a shift away from any kind of growth and towards shoring up the core.
Okay, now here's the part I found truly fascinating. The operational decision that tells you management finally gets it. They are reversing phase one of their back-of-house efficiency initiative.
This is the critical insight. It shows a major priority shift. They're choosing operational integrity, the guest experience, over cost savings.
So what did that initiative do that was so bad?
Management said that while it was delivering savings, the new processes made consistent execution more challenging. In other words, it was hurting food quality.
So they admitted their drive for efficiency was actively poisoning the well, damaging the core product.
Yes. They basically said, if we have to sacrifice planned savings to get food consistency back, we will do it. That's a huge admission that the brand's self-inflicted wound started right there on the plate.
And that focus on the food is showing up on the menu too.
It is. They are leaning back into heritage. They're bringing back beloved dishes guests have been demanding, campfire meals, Uncle Herschel's breakfast, chicken and rice.
All the classics.
Exactly. The culinary equivalent of a safety blanket. They finally realized people don't go to Cracker Barrel for innovation. They go for reliable comfort.
And they're also adding some new value items, like a breakfast burger and a $19.99 meals for two deal.
Right. Hitting both craveability and the budget-conscious shopper. And connecting all of this is their loyalty program, Cracker Barrel Rewards.
How big is that now?
It's huge, over 10 million members, and it accounts for 40% of their track sales. This gives them a really targeted, low-cost way to push promotions like BOGO offers, a new military discount. It's much cheaper than the broad advertising they just cut.
So let's look ahead. This is now a multi-year turnaround. We have to talk about the guidance reset because those numbers are just alarming.
They were severe. Full-year revenue guidance was cut to between $3.2 and $3.3 billion. But the headline that really caused distress was the adjusted EBITDA guidance.
They just hacked it.
They hacked it almost in half. The old range was $150 to $190 million. The new range is just $70 to $110 million.
And the commentary around that new range tells you everything you need to know about how uncertain they are.
It does. The low end, that $70 million, assumes traffic stays at this deeply depressed negative 11% level all year. The high end assumes they execute perfectly and traffic starts to gradually improve in the back half. That is a massive band of uncertainty.
And this is all happening against a very challenging shareholder environment. How much time do they really have before activists force their hand?
That's the question. The stock is down roughly 50% over the past year, while the broader consumer sector, the XLY, was flat to up. This massive underperformance is just fuel for activists like Big Laurie Capital. The narrative has officially shifted from stability to a high-stakes turnaround.
But interestingly, they kept the dividend. 25 cents a share. Is that a sign of confidence or is that just irresponsible?
It's an important detail. It provides a psychological floor for the stock, and it suggests they still have confidence in the balance sheet. They have $485 million in liquidity, but, maintaining that dividend makes hitting those $20 to $25 million in cost cuts absolutely critical. If they miss, that dividend is in jeopardy.
Okay. We come now to our segment. This is not financial advice. Given all this risk, the shocking traffic, the activist pressure, what outrageous but plausible trade idea comes to mind?
The setup here is classic, right? You have a stock getting crushed by self-inflicted wounds, pushing it into deep value territory, but the execution risk is so high you need protection. That negative 11% traffic trend is the sword hanging over everyone's head.
So what's the move?
It's a bit complex. You go long CBRL stock, but primarily as a dividend capture play. You're betting that the 25-cent quarterly payout, the one payable in February, gets honored. You're banking on the activist floor, and those G&A cuts stabilizing the price here, giving you a high yield. However, at the same time, you purchase long-dated, out-of-the-money put options, maybe 6 to 9 months out. That's your hedge against catastrophic risk.
And define catastrophic risk in this case.
Traffic failing to stabilize at all, meaning they report another quarter of negative double-digit declines, forcing another guidance cut, or the activists force some value-destructive pivot, like a fire sale of assets.
So you're betting on stabilization, but you're insured against a total disaster.
Exactly. It's a way to play defense while trying to snag some of that yield.
That is certainly a trade. So to recap this deep dive, Cracker Barrel reported a major financial reset. Profitability is evaporated, traffic is down sharply, but management is now aggressively cutting costs and, most importantly, refocusing on the core brand. Food, heritage, and their loyalty program. It's a full-blown turnaround story.
And here's a final provocative thought for you to chew on. Management noted that their Google star rating is a key leading indicator of guest satisfaction, and it's strongly correlated with traffic. They've already seen improvements of 3 to 4% in food and service metrics since October.
Okay, that sounds good.
But here's the challenge. The typical Cracker Barrel guest only visits about twice a year. So you have to ask yourself, how long will it take for those internal satisfaction improvements to actually translate into meaningful traffic recovery? And will investors, and more importantly, will the activists tolerate that timeline?
That clock is ticking, and it's ticking very loudly. We appreciate you tuning into this breakdown of the Cracker Barrel fiscal Q1 2026 earnings. We'll catch you next time for the next deep dive.